Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, June 9th, 2026, and we're watching some interesting dynamics as AI trade takes center stage while crypto markets face continued pressure. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is the resurgence of AI and chip stocks driving a broader market recovery. We're seeing Nasdaq futures pointing to further gains with companies like Nvidia, Marvell Technology, and Broadcom leading the charge. Wall Street is rushing to fund AI investments in every conceivable way, and this is creating a clear rotation out of other asset classes. What's particularly notable is that Maxim Group just raised Apple's price target to $350 based on AI progress, and we're seeing microchip companies launching new platforms that are getting positive market reception. On the flip side, we've got oil prices declining as Israel-Iran attacks have halted, and China is slashing imports. Trump is trying to convince markets that an Iran deal is close despite recent violence, which is adding to the downward pressure on energy. Then there's the major corporate activity with GSK agreeing to buy cancer drug maker Nuvalent for $10.6 billion ERS, causing shares to surge 39%. The juxtaposition here is interesting because while we're seeing these massive deals and AI euphoria, there are underlying concerns about consumer spending, with rent now, pay later loans targeting squeezed consumers and a beloved fast food chain closing over 700 locations.
That's quite a divergence between the AI optimism and some of these consumer pressure points. What does this mean for traders and investors looking at the broader market?
The key takeaway is that we're in a very selective environment. JP Morgan came out saying stocks will power through any short, sharp pullbacks, but that confidence is really concentrated in the AI and technology sectors. For traders, the opportunity is clearly in chip stocks and AI-related plays right now. The market is essentially making a single bet, as one Wall Street Journal headline put it, and that bet is on artificial intelligence. However, this creates risk because when markets become too concentrated, any disappointment in that sector can lead to outsized corrections. On the technical side for the indices, the S&P 100 is showing resilience above key support levels, with the AI trade providing a floor. We're seeing buying interest every time we approach the 50-day moving average. The Nasdaq is outperforming as you'd expect given its tech-heavy composition, and we're looking at potential to test recent highs if this momentum continues. The Dow is lagging because it has less AI exposure, but it's holding up reasonably well thanks to some of these large corporate deals providing support. The real question is sustainability. We're seeing Wall Street rush to fund AI in every conceivable way, which historically can be a sign we're getting extended. For investors with a longer time horizon, the AI thesis remains compelling, but I'd be watching position sizes carefully here and making sure portfolios aren't too concentrated in one theme.
That selectivity you mentioned is critical. How should traders be positioning given these cross-currents with oil weakness and consumer concerns alongside AI strength?
The positioning strategy needs to be tactical. On the long side, focus remains on semiconductor and AI infrastructure plays, but use any pullbacks as entry points rather than chasing at current levels. The oil decline is actually a mixed signal because while it can help with inflation concerns, the reasons behind it, particularly China slashing imports, speak to global growth worries. That's not bullish for cyclical sectors. For the consumer discretionary space, we need to be selective. The fact that rent now, pay later loans are targeting squeezed consumers tells us that affordability is becoming a real issue. I'd be avoiding the lower-end consumer names and sticking with companies that serve higher-income demographics. The corporate M&A activity, like the GSK Nuvalent deal, shows that companies with strong balance sheets are hunting for growth through acquisitions, which can create opportunities in biotech and smaller cap names that might be acquisition targets. From a risk management perspective, keeping some cash on hand makes sense because if this AI concentration unwinds, we could see some volatility, but the trend is your friend until it's not. And right now, the trend is clearly favoring technology and AI-related sectors.
Now let's turn to crypto markets, which seem to be facing some headwinds. Lizzie, what are the latest trends you're seeing in Bitcoin, Ethereum, and Solana heading into next week?
The crypto picture is looking cautiously bearish to outright bearish, depending on which asset we're discussing. Bitcoin is in a tough spot right now, trading around the 62,500 to 64,000 range, with spot Bitcoin ETFs experiencing $1.7 billion in outflows over a 4-week streak. That's significant institutional selling pressure. However, we're seeing some interesting counter moves, with strategy purchasing 1,550 Bitcoin and adding another $100 million despite the controversy around their positioning. The technical setup suggests Bitcoin's $60,000 support level is vulnerable, and some analysts are pointing to a potential move down to $53,000 based on historical 4-year cycle analysis before we see the next major high in 2028. The critical catalyst this week will be US inflation data, which could provide direction on institutional versus retail positioning. It's fascinating because institutions are actually split right now. We're seeing outflows from ETFs, which represent more passive institutional money, But active players like strategy and mining companies are accumulating on dips. Retail sentiment has turned quite negative given the price action, and we're seeing less speculation in altcoins, which typically indicates retail is stepping back. For Ethereum, the sentiment is mixed to bearish. We're seeing Bitmine making massive accumulation moves, with their treasury reaching 5.54 million ETH each, nearing a 5% supply target. They made their largest Ether purchase in 2026 during this recent dip, which shows conviction from at least one major player. Circle also just launched Sierra BTC on Ethereum, which is their wrapped Bitcoin product that could drive network activity. However, despite this institutional buying, ETH is nearing $70,000 with real risk of retesting $1,500. The correlation with Bitcoin remains strong, so Ethereum is essentially following Bitcoin's weakness despite these positive developments on the institutional front. Solana is the weakest of the three with a clearly bearish outlook. There's limited positive news flow, and headlines are actually questioning whether Sol will revisit $40 before the next bull market begins. That's not the kind of sentiment you want to see if you're holding Solana. The lack of positive catalysts combined with high correlation to Bitcoin and Ethereum during downturns suggests Solana could see sharper corrections than the larger cap cryptos. Overall, institutional money in Bitcoin specifically is becoming more bifurcated. The ETF outflows show that passive institutional allocators are reducing exposure, likely due to macro concerns and the opportunity cost of missing the AI rally we just discussed. But strategic corporate buyers and crypto-native institutions are viewing these levels as accumulation opportunities for the long term. Retail has largely been shaken out with trading volumes down and speculation in meme coins and smaller altcoins way off their peaks. Next week, I'd expect continued downside pressure across all three, with Bitcoin potentially testing $60,000, Ethereum vulnerable to $1,500, and Solana possibly moving toward that $40 level. The inflation data will be the key catalyst that could either stabilize these levels or accelerate the decline.
Thanks, Lizzie and Steve, for those insights. As we wrap up today's Morning Bell, the message is clear: we're in a market of stark divergences, with AI and technology leading, while crypto faces institutional outflows and energy prices decline on geopolitical developments. For traders and investors, selectivity and risk management are paramount in this environment. Stay focused on the data, watch those key technical levels, and don't get caught up in the momentum without considering position sizing. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market insights. I'm Robert, and we'll see you tomorrow morning with another edition of the Morning Bell.